From an asset allocation perspective, when most people think about how to allocate capital, they don't often think about valuation. From our perspective, we think asset allocation should include valuation the same way individual security selection should include valuation. So our view is that anything that pays a cash flow can be valued, and that includes not only individual assets like stocks or shares, but also share markets. And so we apply a valuation-driven approach to asset allocation, similar to how a value investor would apply that to picking a portfolio of shares. We think valuation is just as important at the asset allocation level as it is at the individual security level. So valuation is important because we believe valuations drive both returns and risks. And so when you're looking at valuation, if the valuation, say, of a stock market is very high, that implies returns will be lower, but also that risks will be higher. And so we think returns and risk are joined at the hip by valuation. In this environment, we think a lot of equity markets or share markets are overvalued, or they're trading at high prices relative to their cash flows, which in our view means that there's more downside risk than, say, normally you would see in markets. So therefore, valuation is really important right now because it can help you try to mitigate some of the losses from overpriced assets. So as valuation-driven investors, often assets are mispriced or underpriced because they're unpopular. And so generally markets work well when there's the wisdom of the crowd setting. That is, lots of people have different views and the price is set effectively. But in our opinion, it's when there's a lack of diversity in markets that investment opportunities are presented. So owning investments when they're unpopular, we think is more likely to lead to owning investments that are underpriced. And so the reason why we think they're underpriced is because they're unpopular. And so for long-term investors, there's an opportunity to buy unpopular assets and be contrarian and be paid for it over the long term. The reason why we think you get paid for it is that it's hard to do. Most people like to follow the crowd. It's hard to be different. We think that's one of the reasons why contrarian investing works. Think of it more as a feature rather than a bug. We actually think contrarian investing and value investing go closely together to give you the best opportunity to outperform over the longer term.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.